SPX, 0 days to options expiration trading, has been a phenomenon that swept through trading. And yet a lot of traders are making very common, easy to fix mistakes. And in this video, I'm going to tackle the top 3 that I think if you start using or correcting tomorrow, you're going to see some positive shifts in your SPX trading. And they're really simple. They're the 3 most common mistakes that I have seen. I am just about completed 6 months of testing a specific strategy that we're going to use in the Sector Secrets Mastery exclusively. But I want to give you some more insight into what's working, and in this video, actually, what you want to avoid, right? Avoid those common pitfalls, and you're more likely to turn the corner. And this applies to any kind of strategy that, first of all, I want to emphasize the strategy that I'm testing applies to long calls and long puts, so directional calls in the 0 days to options SPX. The other part of this is by going long calls and long puts, we avoid a very common problem for SPX traders, which is, or any kind of trader for that matter, is what do you do if you have under $25,000 in your account and you're subjected to the pattern day trading rule? There's another reason why I like cash accounts and I like long calls and long puts. It's the easiest way to not have to be bogged down by that particular regulation. All right, so these are long calls and long puts, all right? And that's the strategy. The first mistake that traders make is they bypassed 11 a.m. Eastern. And I say a mistake because, again, remember, we're talking about getting long a depreciating asset and a rapidly depreciating one, because 0 days to options expiration have an exponential depreciation into the latter half of the day, which a lot of you who write options know. So I'm not tackling that. I'm talking about long calls, long puts. So the first mistake is buying the options too late in the day. And the best way to do this is test any approach. I believe in forward testing, not back testing. And that means that when I look at the time a trade was triggered, what does that have to do with mapping to the probability and a positive win rate? And that was a really important one. Now, whether it's 10:55 or 11:05 or maybe past 11:30, you could find a lot of nuance there, but the broad-based, simplest rule is 11 a.m. The number 2 mistake is buying too far out of the money. Now, I know so much of SPX trading is about finding strikes that are affordable, right? Finding a call, finding a put that is something we can buy multiples of and works for our trading budget. Now, this is where we want to get formulaic about it. So first of all, by focusing on really, really, really far out of the money options, you've got to see a lot of movement, not to the strike. You don't have to be at or even in the money to be able to succeed, but you do have to be able to see momentum and preferably a trend towards that strike. And if that strike is way out in Pluto rather than something closer like Mars, right, we're not going to find success here on Earth. The way that I like to do it, and I've covered this in previous videos, is I use the hourly price movement range to find the trigger, and I use the daily price movement range for what strikes I can consider. All right, so buying too far out of the money in the interest of buying a quote-unquote cheap option is actually a really easy path to just rapid premium depreciation, aka a losing trade. The last one is a little bit more nuanced, but it's very important. And there's actually a tie for number 3. It's kind of a tie for the number 3 spot. I'm going to throw, I guess, a bonus in here, okay? The first one is ignoring mixed markets, because when we're SPX trading, let's face it, what are we trading? We're trading the S&P. And the S&P is a little bit like the NASDAQ and a little bit like the Dow, because when you consider the heavily weighted sectors in the S&P, they're the XLK, so think Microsoft, NVIDIA, Apple. They're the XLF, so think Berkshire, JP Morgan, Visa, and it's the XLV. So this is Lilly, United Health, Johnson & Johnson. Some of these stocks are obviously very heavily weighted in the NASDAQ, XLK names, and the rest are heavily weighted in the Dow. So the really important part of this is there has to be clarity in at least the ESYM combination, so S&P and Dow, or S&P and NAS. It's got to be tracking with one of them. Now, the ideal scenario is that we have general risk appetite, meaning Dow is heading higher or lower, right? This isn't just about the long side, higher or lower. The NASDAQ is heading in the same direction as the Dow, and then the S&P follow through is far, far better. So if you go back and you look at your winning S&P days, you're going to find more often than not, you've met those top three criteria. The last one, if you want to call it a bonus, kind of tied for number three, or a bonus in terms of mistakes to avoid, is be aware of the previous session close. And that's really very much why today was a day where I did not trigger at all a trade, which kind of brings us back to this idea of common mistakes. If there is no setup, don't trade that symbol. And SPX has a very low threshold, a very low margin for error for getting into slop. If you get into slop and the market goes nowhere, by virtue of the depreciation, you're going to end up with a losing trade, because as the market goes back and forth, back and forth, back and forth, that out of the money call or that out of the money put is just going to depreciate all the quicker. If there is not clarity above the previous session close or below the previous session close, the trade is much more likely to fail. So there you have it, your three most common mistakes in SPX day trading, as well as a bonus of understanding that PSC, the previous session close. Use these and you'll find that there are days that will simply not yield a trade, and that's by design. I'm flat today on these SPX testing, the 6-month testing, for a good reason. It made no sense to put a trade on. So all a trader would do in a day like today, buying calls or buying puts, is just watch their premium evaporate and turn into a loss. Learn to recognize that early, and you learn to recognize what days you want to avoid. Hey traders, Raghee from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.